We all invest to beat inflation, to achieve financial goals, and to be financially independent. And as per the recent survey by PNB MetLife Insurance, financial goals such as retirement, child's education, and preparing yourself from medical emergencies are the top priorities for more than 50% of Indian millennials. Hello everyone, my name is Shahnawaz and I welcome you all to Friday First Cut. You can't expect to grow your investments if you can't protect your savings. Even if you invest rupees 1 lakhs and compound it with 10% every year, a short trip to hospital or any financial emergency can wipe out your gains along with the principal. So, before starting your investment, make sure you have these 3 things in line which I am going to discuss in today's video. An emergency fund is a financial safety net which you could use to cover any sudden expenses or income disruptions such as job loss, medical emergency, car repair, or any sudden expense. It is important to have an emergency fund set aside because unexpected expenses come unannounced, and if you don't have emergency funds set aside for such unexpected expenses, then probably you might have to use credit cards, take loans, or liquidate your existing investments. The recommended size of an emergency fund is ideally 3 to 6 months of your expenses, which can cover your essential expenses such as your rent, EMIs, child's education, and your food expenses. Also, it depends upon person to person because everyone's living expenses and other expenses, for example family size, income, are different from person to person. You can park your funds as emergency corpus in liquid investment options such as short-term fixed deposits, recurring deposits, and liquid mutual funds. Now, building an emergency fund requires discipline and commitment. You can start by saving at least 10 to 15% of your monthly income and then keep it aside as a part of building your emergency corpus. Overall, having an emergency fund is an important part of financial planning. It can provide a peace of mind that knowing you have a cushion to fall back on in case any sudden expenses arise. As per a recent survey, 17% of Indian millennials have bought a term insurance plan. Most people buy term insurance plan because they want to cover their spouse and kids, and it makes perfect sense. After all, in your absence, you want that your life insurance policy pay a huge sum of money to your family members to protect their future financial needs. And if you have dependence on yourself, make sure that you buy a term insurance plan at an early stage of life. A term plan basically provides a financial safety for your loved ones and your dependents in case of your untimely death. You have to pay a small amount every year to the insurance company, and this small amount is known as premium, and in return the insurance company will give you a life insurance cover which could be used to protect your loved ones and your dependents in case of your untimely death. Ideally, you should have a life insurance cover of at least 10 to 15 times of your annual income. For example, if someone's annual income is rupees 10 lakhs, then definitely they should have an insurance cover of at least 1 crore to 1.5 crores. Also, you get a pretty good bargain if you purchase a life insurance plan at an early stage of your life. Also, the premium that you're paying for the purchase of your life insurance plan, that amount of your premium could be utilized to claim a deduction under section 80C up to the extent of rupees 1.5 lakhs. So, have a term plan, protect your loved ones and your financial dependents, and additionally, you can also save taxes by claiming a deduction. The third and the most important thing that every individual should have before starting the investment journey is to have a sufficient health insurance. Do you know 2/3 of your medical bills are paid out of pocket, and this amount goes towards fulfilling expenses related to hospitalizations, and it's wiping out your savings. Medical inflation is growing at over 10% in India. Although healthcare procedures have become more accessible, but a stay at the hospital can set back quite a bit because eventually the room rents of the hospitals have become very expensive. A single day stay in a private room in a private healthcare facility in Mumbai can cost you over rupees 10,000 a day. But if you have a medical insurance, you can protect your savings, beat medical inflation, and have a tax deduction and tax benefit at the same time. So here's what you should do. Get yourself a comprehensive health insurance with a medical cover of at least 10 to 15 lakhs, and this cover is over and above the cover that is provided by your employer. It is also important to understand the terms and conditions related to your health insurance plan, such as any exclusions, limitations, or waiting periods. So remember, before planning and starting your investment journey, make sure you have these 3 things in line so that you could be financially protected and save your hard-earned money from any financial or medical emergencies. For more such videos, make sure to subscribe our YouTube channel.